Welcome back to the portfolio, everyone. And in this video, we're going over 7 stocks you should keep your eye on this week. These are 7 companies who all report their latest earnings over the upcoming week. And over the past quarter, we've seen the reopening of the economy, and these earning reports may show hopes of an economic rebound. All 7 of these companies share their latest quarterly results. When those results come out, there's usually a lot of volatility with share prices, which may create a nice buying opportunity. And of course, it gives us more insight on the state of the economy and if we believe the stock market and the overall economy will continue to recover and grow to new highs. If we take a look at my current portfolio, sitting at a value at over $61,000 and up over 5% right now. And this week of earnings could be a nice positive force to drive the market higher. As we are still waiting to hear on a stimulus package and negotiations are stalling, it'll be very interesting to see if some of these large mega cap companies report some nice positive results. It will help force the market even higher. We have some of the largest financial institutions in the world reporting earnings this week, as well as some of the largest healthcare companies on the S&P 500. So before we jump into stock number 1, I'm going to ask you to please hit that like button and subscribe. As you know, I am the Gen Z investor, and every single day we talk about the stock market. We go over different stocks you can buy, overall stock market performance, and any other big stock market news and headlines. So please hit that like button and subscribe. I want to jump right into the first stock to keep your eye on this week. It is ticker symbol J&J, Johnson & Johnson. This healthcare company is extremely large with a market cap at around $400 billion, one of the largest, most stable companies in the S&P 500. They are up over 16% this year, and they are reporting their earnings this week. This is a nice stable holding in a lot of people's portfolios. This company is up over 58% over the past 5 years, and they have a nice diversified stream of revenue in a bunch of different healthcare sectors of the market that relies heavily on their goods for use. This company has a lot of standout brands, and overall, their products are always in demand regardless of good times and bad times in the economy, so they have nice, consistent, growing revenue year over year. They are a dividend king with a growing dividend at over 58 consecutive years, and they're currently yielding 2.68%. They're only paying out around 51% of their earnings as a payout ratio, which just shows they have a lot of money left to reinvest back into the business and a lot of money left to actually grow that dividend each and every year moving forward. And they have a beautiful 5-year dividend growth rate average of around 6.3%, which is great to see. And for all of these companies today, every single company we're going to talk about this week, they all report their earnings and they all pay out a dividend. So every single one of these companies returns shareholders' capital each and every quarter, and what we're going to do is take a look at their dividend safety score. This is just a quick indication of one single number from Simply Safe Dividends. They compile a bunch of different financial information from each company and give you one easy to read category and number to help show you the dividend safety of that specific company. 99 is the highest and most safe, secure dividend possible, and that is what Johnson & Johnson comes in at. Their dividend is considered very safe, a company that has a proven track record of maintaining and growing their dividend payment and is very safe, and it is extremely unlikely that we will see a dividend cut happening anytime soon. Stock number 2 on our list today is another healthcare company, United Healthcare Group, ticker symbol UNH, a market cap of over $311 billion, an extremely large company that is up 47% over the past 12 months, and is up over 174% over the past 5 years. Another company where, regardless of good or bad economy, their products and services are always going to be in demand. Another nice dividend-paying company, yielding 1.53%. They are only paying out around 30% of their earnings in the form of a dividend, and they have an insane 5-year dividend growth rate of over 24%. They've been growing that dividend at a very fast rate. So although your starting yield may be on the low side, that dividend is growing extremely fast year over year. They are also ranked at a 99, which is represented as the safest score possible. Another company where if you were to buy in today, lock in the current yield, that dividend income is expected to grow at a very fast rate each and every year moving forward without worry of a reduction anytime soon. Stock number 3 is Honeywell. currently $174 a share. They took a beating in the month of March and are actually trading below the pre-pandemic high of around $180 to $184 a share. The company is up 9% this year and has a current market cap out of $122 billion. Over the past 5 years, they're up 72%, so they have nice long-term share price growth, and they're trading at a forward PE of 25.26. This is another company whose current dividend yield sits at over 2.1%, paying out a sustainable 54% of their earnings, and have been growing their dividend at over 13% averaged over the past 5 years. So once again, this is another company, reports earnings this week, another interesting brand to keep your eye on, especially during this kind of recovery quarter for the economy, and a nice, consistent, growing dividend payer with, once again, the highest dividend safety rating possible coming in at 99. They pay out a very safe dividend. So this is the first 3 companies on our list today, all have a dividend safety score of 99. All of these companies pay out a very safe and growing dividend. So for any of these picks this week, if you were to buy in today, lock in that current dividend yield, you're going to see a very safe growing dividend that is expected to grow over the long term. Stock number 4, we're getting into the financials. JPMorgan Chase, currently at $101 a share. They are still down 10% this year, and you can see here since the March lows, where they were trading at around $137 to $140 a share, they've seen a rapid decline and have been slowly increasing, but staying around that $100 price point over the past 6 months. Current market cap at over $308 billion. This is the largest American bank on the stock market. They are a dividend-paying company, of course. Banks are known for paying out nice growing dividends, with a yield of 3.56%. They're paying out around 60% of their earnings, and they've done a beautiful job of growing that dividend at a rate of over 16% average over the past 5 years. JPMorgan Chase did pass the Fed stress test a while ago, but as of right now, they are not allowed to grow the dividend, but they are allowed to maintain their current payment at this $3.60 level. The financial sector is still up in the air with extremely low yields and still some uncertainty about the recovery of the economy. Their dividend safety score is at a 60 right now, so it's considered borderline safe. This is still on the low side if you're looking for some safe consistency, but I believe, in my personal opinion only, not financial advice, that the financial sector will eventually recover, and some of the bigger names that we're going to talk about will be able to sustain that dividend payment, and once again, when their regulators allow them, continue to grow it each and every year. Stock number 5 is ticker symbol TSM, Taiwan Semiconductor Company, up 82% this year, and a massive market cap at over $410 billion. This company has long-term growth of over 304% over the past 5 years, and is one of the largest companies in the market with a massive $400 billion market cap. Current dividend yield at 1.9%, a payout ratio once again of only 53% of their earnings, and they have a 5-year dividend growth rate of over 30%. But if we take a look at that dividend safety score, coming in at 62, so it's considered safe. You can see here they grew their dividend at a rate of 19% last year, which is very fast. So another company where you're locking in kind of a lower yield right now. The dividend safety score isn't the highest compared to a J&J or United Healthcare Group, but still considered safe at this point, which kind of means at the current level, the company can maintain that payment, but they'll need to improve and grow revenue and earnings if they expect the dividend to be sustainable over a longer period of time. Stock number 6 is the second largest financial institution in the world, which is Bank of America, currently at $25 a share, down 9% this year. Once again, similar chart to JPMorgan Chase, around $35 a share before the pandemic. They've been hit extremely hard and have been trading flat. For the past 6 months, their charts are almost identical. JPM was down 10% over the past year, and Bank of America is down 9%. Market cap at over $219 billion. This is the second largest bank by market cap in the United States. Currently yielding 2.84%, paying out around 40% of their earnings, and a massive dividend growth rate of over 40% averaged over the past 5 years. But once again, another company that currently is not allowed to actually grow that dividend payment right now. The dividend's going to have to stay at that 72 cents per share mark. Dividend safety score coming in at 55, still considered borderline safe. similar to J&J once again. And you can see here from the dividend chart, during the financial crisis in 2008, 2009, they were forced to slash that dividend payment. And since that point, they actually maintained the same payout for a couple years. Then they considered growing it again, and that's where we are today. The final stock on our list today is another high dividend yielding stock, Walgreens Boots Alliance, ticker symbol WBA, currently at $36 a share, down over 30% this year, markup cap of only $30 billion. They report their latest earnings this week, and this will be an interesting company to take a look at. A retailer in a space of the market where there's still demand for their products. We'll see if they have a little bit of a recovery. Well, their numbers are going to be very interesting for investors. It will kind of give a nice outlook on the overall kind of retail space because they sell mostly necessities, products that you're going to need no matter what. But they have a massive dividend yield at 5.15%, payout ratio of only 40% of their earnings, and they've been growing that dividend at a rate of over 6% averaged over the past 5 years, which is great to see. And finally, to wrap up, their dividend safety score comes in at 79, which is considered safe. So a company where over the short term, we don't have to be too worried about that dividend. So those were 7 different companies who all report earnings this week. Every single one of those companies will give out their latest quarterly results, which may lead to a nice positive recovery in the stock market if these companies can beat expectations. But overall, every time earnings reports come out, there's usually a lot of share price volatility. So keep that in mind. Add these companies to your watch list. If you need to add into the healthcare, consumer, retailer, or even financial sector, this may be a nice week to do just that. So as you know, everyone, I am the Gen Z Investor. We post on YouTube every single day about the stock market. So please hit that like button and subscribe, and I will see you in tomorrow's video.